Our next guest says she's expecting a hike in July, but thinks the central banks need to, quote, break the back of employment to truly tame inflation. Joining us here on set, Alexandra Wilson-Elizondo, Deputy CIO of Multi-Asset Solutions at Goldman Sachs Asset Management. It's great to have you. Thanks for coming in.
Thanks so much for having me.
His comments really did circulate around labor balance, and that's driving consumption. And in his view, that's what's driving the economy right now.
Absolutely. From our perspective, I mean, it's going to be very difficult to out-hawk the Fed right now. They're very focused on second-order inflation effects that the BOE is currently experiencing, and the data that we've seen and the momentum of the data that we've seen since May has all been on a positive trajectory. So it's really interesting because we're about to hit the beginning of the third quarter, and this is when most people said the recession was going to start, and we just don't see it. And that's a huge part of how we're looking at markets and allocating portfolios. It's late cycle for us. It's not end of cycle.
That said, the dots moved year-end unemployment down, right? Were they 4.5 and came down to the low fours, right? They're sort of seeing the same things you are.
They are. They were very specific. They threw the kitchen sink at inflation this last meeting. The target was to tell the market we are staying higher for longer. The market was pricing in cuts. Those are completely priced out at this point. They just don't want to see that easing and that tension release from the market as it relates to, conditions easing.
How much of a potential recession, though, at this point is priced into the market?
So when you look at the yield curve, it's telling you, pretty significant story. It's one of the indicators that's flashing recession. But historically, you look at when it started, the inversion, that was last year timeframe, somewhat close to October is when it got pretty significant. Usually it's about 12 months later. So that would get you to November when you start to see some version of economic contraction. Now, we do agree that you're going to see the economy slowing, and it is, but it's slowing very slowly. And that gives people time to adjust to higher interest rates. And the corporate and the consumer has really smoothed the vol of higher rates. And we think that that's meaningful.
Does that explain what's happened to housing as people have had time to assimilate to 6.5, I guess 6 3/4 today?
Yeah, I mean, when you look at housing prices, that's one of the data points that's really showing you that things are pretty stable. That's a lot to do with supply. So supply hasn't really come to market because the consumer balance sheet's pretty strong. So people aren't going to be forced sellers. They don't want to, go into new mortgages when they have a 30-year at 3%, if you will. So, the housing market's a little bit less rate sensitive than people were originally expecting.
Yeah, just given kind of the supply and demand dynamic there.
Exactly.
As we look toward the future, we have a 71% probability of a rate hike. At least that's what the markets are pricing in July. You believe it's actually higher than that? You think it's almost a near certainty that we will see a rate hike? And what is fueling that hypothesis?
Yeah, it's a really high bar for them, in our perspective, to not hike. Just the momentum of the data, everything we've seen this week. Now, we do get really important data on Friday in terms of PCE. We're not expecting that to be a blowout number, but we are expecting last month to be revised up somewhat. And at the end of the day, you've got rolling payrolls, 3-month payrolls at 300K. That's nowhere near that 80K neutral level that the Fed has even established themselves. And when you think about the employment backdrop, the cost to deliver stuff, it's wages. So they're very focused on that.